Hello guys, welcome back to Zyler Vance. I'm Zyler, and welcome to today's new video. Guys, in today's video, we're going to talk about something most people aren't paying attention to, a quiet shift happening in global finance that could change who controls money in the next decade. This video is not about crypto hype or price predictions. It's about power, infrastructure, and why stablecoins are becoming the new battleground between nations. Before we jump in, make sure you like this video, subscribe to the channel, and turn on notifications so you don't miss future updates. This channel is all about staying ahead of the curve, not reacting after it's already too late. Alright, let's get into it. While Washington argues over outdated financial rules, a new monetary system is quietly being switched on elsewhere. No headlines, no announcements, just infrastructure. This isn't about crypto prices or market hype. This is about who controls the rails that move money across the world. In 2026, global finance has entered a new phase, one that looks less like innovation and more like a strategic standoff. The weapons aren't missiles, they're stablecoins, and the battlefield is liquidity. For decades, U.S. financial power came from controlling settlement. The dollar moved global trade, banks controlled access, and the system rewarded those already inside it. But that advantage is no longer uncontested, not because the system collapsed, but because alternatives quietly became functional. Every major economy has reached the same conclusion. Whoever controls stablecoin infrastructure will shape global trade for the next generation. The United Kingdom is accelerating digital settlement frameworks. Japan is pushing forward with yen-backed stablecoins to protect domestic industry. Singapore is positioning itself as a neutral hub for global liquidity. This is not about crypto adoption, it's about financial sovereignty. And while the U.S. debates legislation, others are already deploying. Now, let's talk about what most Western investors are not watching. Russia didn't simply open crypto trading to individuals. That was the visible move. Behind it, a parallel settlement system was activated designed to operate without Western banks, without SWIFT, and without external permission. At the center of this system is a ruble-linked stablecoin known as a 75. It is not built for speculation. It is built for settlement. Over the past year, its transaction growth has outpaced major dollar-backed stablecoins. Daily volumes have reached levels that make one thing clear. Restrictions don't stop capital. They redirect it. Capital behaves predictably. It avoids friction. It follows efficiency. When traditional systems become slower, more restrictive, and less rewarding, liquidity doesn't protest. It migrates. Stablecoin rails like A75 are now being used for cross-border trade, energy settlement, and regional commerce outside of legacy financial systems. This isn't a loophole, it's a replacement layer. Here's the part regulators underestimate. This isn't just about bypassing today's restrictions. It's about building a digital native financial environment. Countries that normalize on-chain settlement, digital wallets, and programmable money are training their legal systems, institutions, and workforce for a fully digital economy. While the West tries to fit stablecoins into 20th century banking models, others are building entirely new frameworks from the ground up. The resistance isn't really about risk, it's about yield. Traditional banks operate on fractional reserves. Deposits generate profits, but very little returns for the depositor. Fully reserved stablecoins change that equation. By holding short-term treasuries, issuers can pass yield directly to users. If individuals can earn several times more on digital dollars than in traditional savings accounts, capital flight becomes inevitable. That's the real threat. This is why support collapsed around the latest market structure bill in the U.S. Senate. When Coinbase pulled its backing, the message was simple. Regulation cannot be used to protect legacy profits by blocking competition. Innovation doesn't stop. It relocates. You can restrict stablecoin yields domestically, but you cannot restrict global efficiency. If U.S. dollar-based stablecoins are constrained, liquidity will move to alternative systems, whether that's digital yuan networks, yen-based rails, or parallel settlement layers already in operation. This is sovereign-level arbitrage, and history shows that the most efficient system eventually wins. The noise is in Washington. The signal is in infrastructure. While legacy institutions build walls to protect old models, the rest of the world is building new financial plumbing. This isn't a market trend, it's a system transition. The real question isn't which asset pumps next, it's which network will settle global wealth for the next 50 years. Ignore the noise, watch the rails. Efficiency always decides.